Hello and welcome to the Unemployed Value Degen's YouTube channel. I'm sitting down with one of my former students, Colin, who works in the industry, so we'll be leaving his camera off for compliance reasons. This is not financial advice, and there's going to be a written disclaimer at the bottom of the text chat. Now, at least every quarter, we like to sit down and look at the different sectors and try and figure out where the general direction of the market is going to be moving. It has been quite an interesting time, and on top of that now we are less than a month away from the presidential election, and the narrative around that has really shifted. It went from a tight race to now it seems like there's a new consensus, and that consensus could change in the next couple of weeks. But it seems like now everybody's predicting a Trump victory, and then I don't know how widespread this is, but everything I keep reading is that a Trump victory followed by a market crash. But there's people always predicting a market crash, so I don't know how accurate that's going to be. But so let's say welcome to Colin. Mitch is taking his turn to be traveling as stopped being a refugee after Hurricane Milton. So welcome, Colin. How are you doing today?
Hey everybody, pleasure to be on. Pleasure to be speaking with you again, Coach. And I'd just like to, parrot your point right there. With this Trump trade going on, everybody's always going to predict a market crash at any point in time. That is something I really loved learning about in grad school. At any point in time, there's going to be somebody predicting a market crash. You can
Yeah,
never really take everybody's word for it because then the market would never go up. But
yeah.
yeah,
Well,
there's a lot of reasons for why that might be the truth, though. A Trump trade kind of running up into the election and coming down after, there's a lot of different talking points that could be, taken into consideration with that. You really have to make your own decision as a trader to position yourself.
Well, there does seem to be a consensus that the market is going to rally into the end of the year before the crash. So there's two things going on. One is which sectors are going to be the hot sectors for 2025. Well, we still have the last couple months of the year here, and the last couple months of the year we're going to have tax loss harvesting. So things that have been losers are going to keep on losing and maybe lose harder. And then you're going to have performance chasing, where money managers are going to be buying the stuff that's been working. And then along comes January, and people are going to say, "Hey, let me take some gains early in the year when I have all year to make a profit off of that money before I have to pay taxes on it." So they might have a very where tech has run up so hard this year. You might have a very different phenomenon happening in 2025 versus this last bit of the year. In fact, one of the things that's been going on is if you look at, I've got a 5-year technical chart here of the triple Qs of the NASDAQ, and we haven't broken out past that June-July peak. I have this out 5 years to see this shape better from the COVID lows. Let me just go into 1 year and just take a look at this. Yeah, so we're still a good bit below this July peak in the NASDAQ, but on the S&P 500, it's a different story. On the S&P 500, the S&P 493 are doing the work, and the S&P 493 have brought the S&P 500 above that July peak. So 2025 might have a change in leadership. You might have the artificial intelligence trade, which it's going to be a 10-year story, but it might take a breather, right? It might be flat, it might be down for 2025.
I
Who
mean, I think
knows?
we've already seen the beginning of that. So much money has been flowing into financials this year specifically, as opposed to AI last year, where that might be a little bit of rotation out into something a little bit more diversified, as opposed to that really niche tech.
Yeah, and
But when you look at financials, you could see the same story of they've had such a run over the past 6 months, a year. Yeah, look at there, the
yeah,
financials taking up 25%
financials
change.
year to date now are the top, not the top, utilities is the top performing sector, but financials are beating tech, they're beating communications, industrials are coming in strong, but financials, and it's only been this financials line. This chart goes all the way back to the last crash in the fall of actually no, where does the bull market officially run here? So I say have this as the fall of 2022. So this is now a 2-year look back. And financials, they were just kind of chugging along middle of the pack up until just a few months ago, and they've had this really strong rally on that first rate cut. But if you look year to date, yeah, year to date financials are are crushing it. Utilities has the benefit of the rate cut and the artificial intelligence connection. So it's bizarre for utilities to be the top performing sector. I mean, what kind of world do you have to be in where utilities is beating tech and communication services? It's just a bizarre time year to date.
I mean, I guess that could be sector rotation, kind of how you're saying. Are people going to take their tax hits? Are they going to start taking profits? Or are they going to wait? This
Yeah,
is what I see. This is, I guess, the argument I would put forward for why it's already happening. You see tech kind of not running as much as it used to with that could be a rotation into financials and then in utilities. But one thing I've seen that's been kind of surprising me is healthcare taking some real hits. It's up
yeah.
year to date, but in the past week or so, it's been taking some hits, really big declines in a few different specific names. Let me pull some up.
Yeah, this is one
There's
of the sectors that I was
ELV.
going to point to for possibly a 2025 target as a sector to try and add some more to, because you have it for 2023, very bottom of the pack, coming in at a 2% return for 2023, and year to date it's up 14%, which is great. I mean, nobody's going to sneeze at 14%, but it's underperformed on a relative basis. And you don't see a lot of years. I mean, if you just look back to this quilt goes to 2009, you don't see healthcare showing up at the bottom half of the screen 2 years in a row before. You have healthcare typically coming in the top five. It's usually a very strong sector. So I think there might be some real pent up performance for healthcare. That's one area to look at. What are your
Well, they've
thoughts on
had
that,
some
Colin?
runs. Like you said, it's not often that's going to be down there too long. Any time it's down there towards the bottom, I'd say kind of 23 is towards the bottom. It's only down there a year and it kind of snaps back.
Yeah,
The reason I'm concerned about it or even looking at it is because it had a decent year. It's had a decent couple of years, but it's coming down a lot lately. These past earnings season for healthcare companies has been kind of a slaughter. A lot of the issues have been, that investors and traders, they're listening to these earnings calls and they're getting basically like a cost shock. All these costs that they knew were going to come, they knew they were going to go up, all this, all the spending that these companies have to do. They knew it was going to increase, but
yeah.
they didn't expect it to be so dramatic, so fast, so rapid, and that's what's happening. These companies are getting hit with a higher inflation costs than they thought, pretty much just on the, expense side of things, nothing they can really control. And investors are getting spooked. They're pretty bearish. You're seeing some pretty big drops in some pretty big names. ELV, UNH, HUM. It's been a little bit spooky in that area. But if again, looking at the long term, it's kind of holding up, so to speak. But right now this year, you kind of don't want to be in those names. The past month at least.
Well, I've got it broken
Better
down
place
into
to be.
subsectors, and I have surprisingly pharmaceuticals year to date are up almost 20%.
Yeah,
Um,
pharma's always going to be a different kind of game than your traditional healthcare. When I'm talking more your traditional like your insurers, those healthcare coverage groups,
yeah,
UNH,
insurance
pharma,
might be in the
mixed bag.
financials, I think.
Yeah,
But
you're right. You're right.
so what's really been struggling is healthcare providers and services, which makes sense because they're suffering under the labor costs from these nurses that the shift nurses during COVID were getting paid extreme salaries. Life science tools and services, healthcare providers and services. I mean, you've got the 5 year for that was up 93% for healthcare providers and services, but the 1 year is up 4%. So the question is this a coiled spring or is this going to get beaten down for another year? I know Mitch had found a company that was in a publicly traded employment agency that focuses exclusively on doctors and nurses. That sort of thing, if this healthcare providers and services is really a coiled spring, that might be pretty attractive. I don't know. What are your thoughts, Colin?
Yeah. Coiled spring could be, but I don't know. You got names like CVS kind of down 8% just on Friday, I believe. And the issue is really just, misses on their earnings per share. And again, that's a lot due to costs, like much higher costs than
Yeah.
they're expecting. When we're in a position like this, it's just not somewhere I'm trying to allocate capital. But if you're thinking on a real long-term kind of schedule and you're looking for some blue chips, maybe you could find a couple in there. But just given just kind of the prevailing bearishness tone.
Yeah.
I don't know if this is a space I want to be in right now,
Yeah,
or at least
this could be a
somewhere I wouldn't want to get rid
2026
of.
story.
Yeah, it's just not something I'd want to be trading. If anything, I'd take the short end of it, but
You want to stick
I don't
healthcare
know,
into the
man.
too hard bucket?
Yeah, it's just something where you're not seeing a lot of upside right now,
Yeah.
Maybe some things could shift around, but with those wages with the nurses, like you were saying, that's across the board really in that industry, and it doesn't really go back. It's not like those wages ever really come down. It's just something
Yeah.
that has to be grown out of over time in the industry. But for right now, it's just kind of here to stay, those higher costs, and there's only so much they can do to, get money out of their consumers. There's only so high you can raise your prices without, you know, seeing a consumer not be able to pay it.
Yeah. Well, the prices are all negotiated through insurance and through Medicare. So that's the problem is if inflation drives all their costs up, they have to wait a year before the next negotiation period. Um,
Exactly, exactly. Yeah. And I'm sure the insurance companies aren't trying to pay out as much. They saw this coming, probably locked stuff in earlier than the companies they'll be dealing with, I'm
yeah.
sure they saw this coming and kind of maneuvered around that.
So healthcare might be worth the too hard bucket. You want a dumpster dive and look at what's been losing year to date, or do you want to look at the top performers first?
Yeah, sure.
Well, this one,
Utilities, yeah.
yeah. I mean, utilities up 30% this year. I mean, this is uh, some things like consumer staples are very middle of the pack. Industrials very middle of the pack. Financials kind of middle of the pack. Utilities will spend some time top of the pack, bottom of the pack. But if it's at the top of the pack one year, it's at the bottom of the pack the next year. I mean, I know they have the tailwinds for artificial intelligence, but I gotta be suspicious that there's 2025 could really show that January comes along, people take profits, they sell these names and dump them, and it just can't catch any momentum. And all of 2025, utilities struggle. That's kind of my best guess just by the sector history of it.
I mean, yeah, how often is utilities really running the pack for more than, a brief period? Even in the past couple of years that it was up at the top of the pack,
Yeah,
you don't see it running that crazy. But I mean, this China trade is also something I think utilities need to take into consideration. You see, obviously, China stocks exploding lately due to their stimulus, but will it hold? It's so far showing like they're holding some of those gains, but not as much as you think. They're giving quite a bit, quite a bit of chunks back.
yeah. Well, you're jumping ahead to
Utilities could do the same thing.
yeah, you're jumping ahead to something else I wanted to talk about, which is money inflows and outflows into the U.S. generally. And
Mm.
one real possibility, I mean, there's been a lot of really high-powered talking heads on TV. One was the chief of strategy for J.P. Morgan, and he's talking about how they would prefer to have several years of a weak dollar, and several years of a weak dollar would be would be bullish commodities because commodities are priced in dollars. You'd think it might be bullish the stock market because equities are priced in dollars, and also now the S&P 500, you've got more than 40% of revenues internationally. But who knows? Because the weak dollar could also be bad for the stock market. But that would be outflows, right? That would come from interest rates that are lower than the rest of the world, and investors taking their money out of the U.S. capital markets and reinvesting them back overseas, and looking at Europe, looking at emerging markets, looking at developed markets. Emerging markets have been crushed for, I don't know, at least 12, 15 years. The emerging markets have been underperforming. But at the same time, over here in the U.S., you've got, this is where we have Apple and Google and Facebook and all these companies that everybody wants to own. So, what do you think about the emerging market trade?
Well, I mean, there's definitely been a lot of capital flight, capital fright, whatever you want to call it, going on this week. So, I mean, that money's got to land somewhere. Emerging markets are just somewhere I would allocate if I'm trying to get out of something like the US. I mean, last week we really saw the SPY futures kind of be unchanged, really. Uh, the treasuries you saw coming back a little bit, dollar coming back a little bit, oil coming back a little bit, all of them really reversing some of the gains they made recently. So it's kind of showing me that the market's a little spooked. You saw that big drop in something like ASML, taking the video down with it. This kind of stuff's just kind of showing me that the large caps are taking the brunt of the move.
Yeah.
Also with healthcare. And, whenever you see the money kind of flowing downstream, emerging markets are downstream from these big names like ASML, Nvidia,
Yeah.
the dollar trade, the oil. That's where all the money was flowing before. Now it's coming out. Where is it going to go? That's where you want to be. You want to position yourself ahead of the outflows or inflows, really.
Yeah,
But
I'm
it's
personally hoping for the rotation
emerging.
to
Yeah.
small caps that we've been waiting for 20 years.
Yeah. Yeah. I mean, everybody calls for it every year. It seems like, oh, it's coming, it's coming. Maybe last year we weren't chatting about it too much towards the end of last year, but this year I'm starting to see it come around again. 2025, the year of small caps, but maybe it's just,
Well, the
it's
Magnificent
just one of
Seven has a PE of 26. The
yeah.
S&P 493 has a PE of 19, and the Russell 2000, if you take out the profitless like biotech startups, the Russell 2000 has a PE of 10. So it's definitely ripe for a rotation. And they also have, I think, stronger projected earnings growth. Once the problem with Russell 2000, its sector weight, there's just this huge, massive weight in the Russell 2000 that's profitless biotech. And if you look past that, you've got the small cap companies, there's a lot of really nice things in there. But anyway, you were talking about some of this information technology. And information technology spent the last 2 years right at the top of the pack. Looking at the past history, 2 years at the top of the pack is not really anything you haven't seen before. If you look at 2019, 2020, 2021, I mean, good grief, being in information technology, 50%, 43%, 34%, it can spend 3 years doing really strong returns. So, I mean, next year could be strong in information technology, but I kind of suspect that this is the sort of thing that people are going to sell in January when they want to take some gains and have the year to make money off of it before they pay taxes.
The reason I brought up China is I see that info tech trade kind of being attached to the China trade because the China tech stocks were really what explode the most. Your Alibaba, JD, Baidu, NetEase, Tencent, those are really those names that are exploding the most over in China. And that's really what I think the info tech trade right now has kind of been based on, just either
Yeah.
chasing that or just following those ETFs because they're attached. The passive flows going into those, are just kind of attached to those US names. That's
Well,
kind of what I see going on. So I kind of agree that in January we could see a big, not a big decline, but really a pullback from people taking their money. Heck, I would be.
I
I'd be
jumped
taking
into
the gains.
consumer discretionary because I want to point out so they moved Amazon out of information technology into consumer discretionary, even
Now, that's
though
surprising.
their core business doesn't make any money and their cloud computing is what makes all of their profits. So,
Hmm.
but if you look at consumer discretionary and how it's done, if you keep in mind that the largest holding isn't really consumer discretionary is down here at the bottom of the pack. And this is one that whipsaws back and forth, spends the year at the bottom. I mean, consumer discretionary used to be called consumer cyclical because it's at the top, it's at the bottom, it's at the top, it's at the bottom. So if anything, this might be an area where I want to deploy some capital for 2025. But then when I go look at the sectors of consumer discretionary, then it's a different story. If I look at what's happened year to date, some of it's already been ripping. So like the leisure products, Carnival Cruise Lines and all that, that's 42% year to date. Household durables, I think these are the home builders. So household durables, this is not like washers and dryers. I'm pretty sure the home builders are lumped into there. So you have some really strong stuff in consumer discretionary year to date, and the stuff that's really lagging, it's all auto industry, right? It's will this decreased interest rate, will that be good for automobiles, auto components, and luxury goods, right? So your Louis Vuitton handbags, stuff like that. And I'm surprised by this one because one of the theses that I've been looking at is the K-shaped economy, where the high end is doing well. But at the same time, I guess in the COVID lockdowns, they bought all their durable goods. They bought all their handbags and stuff like that. And after the COVID lockdown, it's all about experiences again and traveling. So you have the Carnival Cruise Lines, Royal Caribbean, up 42% year to date. But you've got the entire, automobile sector negative. Distributors, that would be like your UNFI, United Natural Foods. and then luxury goods. So anything you can think of that's a coiled spring that's gonna be worth looking into and digging into, and the consumer discretionary. But it's a mixed bag because some of it's outperformed and some of it's underperformed.
So, and the one I've been focusing on, just as it relates to this trade, is luxury goods. Those are really where I see the kind of like a relentless bid for their item, so to speak. It's kind of like obviously the consumer is kind of, relenting a little bit, using more credit than cash, that kind of thing. So we're kind of worried about it from an economic stance. But what we see with that market of luxury goods is their total addressable market is going nowhere but up. And a
Yeah,
lot of that, I hate to keep bringing it back, but is China. A lot of that is just the China population coming into the middle class, upper middle class, and just minting millionaires every single day over there, especially with their stock market having this recent rip.
yeah,
I wouldn't be surprised to see a big bump in those luxury products over there, because even though they make the fake ones over there, the people with the money over there still like the real ones. So
yeah,
luxury goods are what I'm kind of keeping an eye on. But it's definitely a tightrope with the way the economy's been moving consumer wise. It seems like it's a good quarter, bad quarter, good quarter, bad quarter for all of consumer discretionary,
yeah.
honestly.
Well, the only consumer, well, the one name that I'm pretty big on, I don't think I could convince Mitch, was the Container Store for the custom closets. I also did a write up on Malibu boats, and if interest rates are coming down, and this is kind of it's not really clear if interest rates are coming down because the more Jerome Powell cuts the overnight rate, it seems like that the higher the Treasury wants to go for the 10-year, because the
Yeah.
market might be pricing in a Fed mistake, a policy mistake, because you have. So anyway, yeah, you've got again Jerome Powell cuts the overnight rate, and the 10-year starts rallying. And well, this is the trueflation data. So you have inflation kind of bouncing off the bottom. Now, part of the inflation story is you had some people like looking at the trueflation index as opposed to CPI because um,
Don't
and for
blame them. CPI is quite a malleable subject these days, it seems.
yeah, the CPI has its problems, and one of the things it does is it takes housing, and it takes rent increases and house price increases, and it kind of spreads them out over several years. So CPI is higher than trueflation right now because when inflation was 9%, prices of the things people were buying were up 14 or 15%. But rather than saying inflation was 14 or 15%, it takes some of those points and spreads them out over the next couple of years. But this hard bounce off the bottom, and so even though it's still spreading out the rent rates, which are still high and might even be increasing now, now you have just regular goods climbing back above 2% also to get averaged in with the smoothed out and spread out housing prices. So people are starting. The idea now is that there's a lot of love for Jerome Powell, but the chatter now is maybe he made a policy mistake. So as he cuts the Fed funds rate, the 10-year Treasury goes up instead of down. I don't know. What's your take on that?
I, Honestly, that's kind of exactly what it seems like the market's trying to say when you see the 10-year reacting where it is. I was, pretty much buying the 10-year up until, up into the rate decision, thinking, oh, it's going to go down. Who wouldn't? And now, next thing you know, it's spiking up, like you said. It's basically doing the opposite of what we would expect. Um, and I guess, yeah, that's really what it's saying, in my opinion. It's really the market saying, "Hey, Jerome, we like what you're doing. A little, too late,
Yeah,
or too early, too much, too early. Whatever the case is, they don't like it. The 10 years been up, you
yeah,
know.
and
The yields is.
yeah, and well, you have Trump who's saying that he will get interest rates down. Meanwhile, we have an independent central bank, and Trump is saying he will get interest rates down, which is
Well, it
kind of
seemed like he
interesting.
succeeded in his first term. I remember that had been a very contentious point back then. People might
Yeah,
not have taken it too serious, but it was exacting some pretty direct influence over the Fed decision,
yeah. Well, that
over the
was
Fed
mostly
policy.
through mean tweets on Twitter. And he seems
I
even
know,
more
yeah.
serious about it this time.
Exactly my point. Yeah, I think he got a little taste for, influence in the Fed back then. He started to
Yeah.
see, oh, people really care about this stuff. It really kind of gets the needle moving, It gets those finance guys, tuning in to see what he has to say.
Yeah. One other layer to put on top of this is a lot of times when you have a business cycle or a credit cycle, like in 2008, you had a situation where the market was fully leveraged. So when the value of the collateral fell, nobody could take out any loans because they had no collateral, because that the mortgage was already, they were already underwater in their mortgage. The market had no collateral left to make loans off of. But on average, after the first interest rate cut, bank lending increases by something like 8% in the next year. Well, that would be like $1 trillion of new loans. That would be like $1 trillion of money creation, because our monetary pyramid, we have the base money supply. Then on top of that, you have the money that comes out of the interbank lending and the creation of new loans. So if we get $1 trillion of new loans made in 2025, think about what that increase in the money supply will do to prices. I mean, we'll be off to the races. The stocks will be rallying. Everything will be rallying with that. Because this is a
Yeah.
very strange business cycle. We've got something like $13 trillion of housing equity that doesn't have any. It's not collateralized, that could be tapped. So it would only take a
Yeah.
trillion out of that 13 trillion to send the market just off to the races in a crazy way. And that could be from, people from the housing market unfreezing, or it could be from cars. So if I go back to this automobiles industry, right? The automobiles industry has been struggling. We're still like a $2 million or 2 million cars a year less than the 2018 peak. So there could be some bump up in the people are just waiting for cheaper financing to buy cars. People waiting for cheaper financing to change houses. I'm not sure. What do you think is the better sector? Things connected to housing or things connected to cars right now?
I would definitely pick housing over cars, just given what I've seen so far lately. I think they both could see a bit of a perk up in the next, moving forward. But namely with cars, you see somebody like Tesla just having these lot full of them, can't get them off the lot. That kind of thing supports your theory of, people just waiting for better terms. But speaking on housing and taking the money out of housing via equity loans, just to add some anecdotal evidence, that's exactly what my family is looking into right now. We're kind of thinking, well, rates are coming down. We got a decent home equity line. Let's start using it.
Yeah,
Why not take the money out now? We could probably invest. We, can almost guarantee we can invest it higher.
yeah. So
Um,
you think people are going to take out HELOCs and put it in the stock market? Is that
they're
what your
gonna be doing
parents are
something
thinking?
with it.
Yeah,
We're gonna be doing something with it. The thing is, when the rates are coming down, why not?
yeah,
If you But it goes back to what will the Fed be doing? They were posturing for a rate cut. They're saying, hey, we're going to bring rates down another couple points in the next year or so. Eh, Are they telling the truth? Do we believe them? Do we think there's going to be another pivot coming? That's really the question when it comes down to housing and, even more so with financing a car.
well, I
But
think
the thing
that's
with
why.
cars, people need cars.
Yeah,
Every few years you're going to see a big pickup in that. And yeah, like you said, we've kind of been sluggish with the cars moving around. So I really do think cars could have a decent next couple years. But I'd be more willing to stick to housing personally.
well, I mean, if people are taking out HELOCs to put it in the stock market, I mean, we're off to the races. Next year is going to be crazy. It is totally possible. I think the Fed funds rate, the market's pricing in something like 2% rate cut. So that would be the Fed funds rate down to three and a third, somewhere around there. I think one of the reasons financials are rallying so hard is because they would see a normal yield curve where the long end was higher than the short end for the first time in a couple of years, which means the banks can make money off of that. But yeah, I mean, I was always thinking, interest rates come down, people will, buy a Winnebago, Harley Davidson, buy a jet ski or a boat. I didn't think they'd do a HELOC and put it in the stock market, but that's entirely possible because,
Or
in
even just another house,
yeah,
that more property. I could see a lot of people doing that. If they see the housing market being down a little bit for the past year, prices are a little soft, they might want to jump in. There's been so many people on the sideline just waiting for an entry into the housing market. They've been discouraged the past few years,
yeah.
but now it might be their time.
Well, the new home builders, because they have such big margin on the houses, they have been willing to drop $20,000 on mortgage rate buy downs. So while while a typical consumer right now is, if you want to buy an existing home, you're looking at a 6.4, 6.5% 30-year mortgage. You can get a low fives, like 5.2, 5.1, just from the new home builder buying down your mortgage rate. So then the new homes have been strong while the existing homes have been weak. And the question is, what is it going to take for existing homes to actually move? And I saw a survey the other day, and it's kind of said 5.5% was the magic number for existing homes to really move. And then what would it take for existing homes to get down to 5.5? Well, typically the spread between the 10-year treasury and the 30-year mortgage, it's been averaging something like 1.5%, 1.7%. But if you look at the 10-year treasury now, like the 10-year treasuries, call it 4.1, 30-year mortgage is 6.5. So there's a 2.4% spread in there. And the historical average is 1.5, 1.7. So it's what's it going to take for that spread to come down? And then you're looking at, you take a look at the Fed balance sheet just for mortgage-backed securities. You have after the global financial crisis where they broke the law because they had no legal right to buy mortgage-backed securities. They created a subsidiary, Maiden Lane, with BlackRock to be able to do it anyway. Started buying mortgage-backed securities. Yeah, financial innovation. What one person calls fraud, another person calls financial innovation. So, they buy mortgage-backed securities, they start letting them roll off, and then you have a panic. They have to buy more mortgage-backed securities. They start letting them roll off, then you have a panic, and then they buy more mortgage-backed securities. And they've let mortgage-backed securities roll off from 2.7 billion down to about 2.2, 2.3 billion. So then the next question is, is the Federal Reserve really going to let this run down to zero over the next 10 years? In which case, if the Fed isn't there to buy mortgage-backed securities, maybe the spread between the 10-year treasury and the 30-year mortgage doesn't come down, and maybe just the housing market suffers for the next 10 years, except for the new home builders, but the existing home market suffers. Or, when do we have our next bout of quantitative easing, right? Because it was from 2013 to 2020. We've been, give or take the average number of years in between spurts of quantitative easing. So is something, I don't think we're going to see that much weakness in the labor market, but at what point does the Federal Reserve, if they just stopped letting mortgage-backed securities run off and started buying them again as they expire to keep this number flat, I think those spreads could come down. So, and it all comes down to what Jerome Powell is going to do. And I wish the Fed wasn't so powerful, because I would love to just be analyzing companies and not analyzing what the central bank is doing. But this is probably what's determining whether the existing home market and maybe even also the automobile market moves, is when are they going to stop decreasing the balance sheet, or keep the balance sheet flat, or quantitative ease again. And they could also, one possibility, because we're running a deficit that's so big, what if the next time the Fed does quantitative easing, they buy treasuries, but they don't buy mortgage-backed securities? They have to choose between the treasury market and the housing market, and they say, screw it, we have to buy treasuries, and there's just not enough ammunition to buy mortgage-backed securities as well. Because we're running a deficit that's 6-7% of GDP. I mean, it's insane. So anyway, and this,
If the runoff would be supported by that kind of idea, maybe also the spread increase and the maintaining of that spread increase, I think that would also be supported by the Fed trying to run these off, into the bank's balance sheets.
yeah.
The banks are obviously going to demand a little bit higher of a spread than the Fed will. That I think the rate spread would be supported by that.
I mean, just simple pattern recognition says we're coming into quantitative easing again relatively soon. But
Exactly.
then there's no obvious, because I'm of the no recession camp. I'm from the Austrian business cycle perspective. I don't see any malinvestment that would cause a business cycle, at least not for years and years and years. Now, if interest rates really are cut low, and with the industrial build out from the reshoring and the AI data center, we might blow one heck of a bubble over the next 5 years if interest rates are kept too low. But I don't see a crash coming imminently. So I think there's a real possibility these mortgage-backed securities just run off for the next 5, 6, 7 years. But the simple pattern recognition says, yeah, like maybe quantitative easing is close, because the Fed this isn't even the whole balance sheet. This is just the mortgage-backed securities component of the balance sheet. But if the Fed runs the balance sheet down enough, it runs into some sort of problem. And we also have, anyway, I don't want to get too much down this rabbit hole, but It's the question, are we close to quantitative easing or is it far away? And if they do quantitative easing, are they only going to buy treasuries because the fiscal deficit is just so big that's the only thing they can buy? And meanwhile, Trump is coming in saying, hey, I want to cut interest rates. Well, how are you going to do that? Because even if you control the overnight rate, without the Federal Reserve buying mortgage-backed securities, getting the spread between the mortgage rate and the 10-year treasury back down to 1.5%, which would put the mortgage rate at about 5.5%, which is allegedly that magic number that would get the existing housing market moving again. Well, I don't know. To do that, the Federal Reserve would have to buy mortgage-backed securities again, maybe. Anyway, that's a long rabbit hole, but we can go back to the sector map.
Financials has been something that's really been something I've been interested in looking at, just the individual names that you do see running and how much they are. And it's really just increased profits, just plain and simple. They're making money. Costs are being controlled. Obviously, inflation isn't much of a concern for them compared to some other places like healthcare. And as far as their profits go, everybody's trading, deals are happening.
Yeah.
There's a lot of activity going on. Things are getting re-rated constantly, repriced constantly. Stocks are moving up. There's nothing but profit going on for these guys. Yeah, as you can see on here, it's just green as far as I can see.
They're all good, but there is kind of a relative valuation difference. The weakest area is capital markets, and all of the earnings calls, Bank of America, not Bank of America, Goldman Sachs, Morgan Stanley, they've all said things are heating up in the capital markets, that we could be getting into a merger and acquisition wave, we could be getting into an IPO wave. And that was one of the reasons why I liked B. Riley so much, is that we're probably getting pretty close to when there's going to be a small cap IPO wave, merger and acquisition wave. Part of the things that's holding that back is Lena Khan at the regulatory level, just preventing all these mergers from happening. But if the capital markets heat up, so companies with exposure to capital markets activity, who's going to benefit from all these M&As, all these IPOs? And until the short sellers destroyed B. Riley Financial, that was my favorite one in this sector to take advantage of this, and now it's just been totally smashed. And I don't know if the reputational damage is so great that they'll miss out on this rally when it happens. So I would love to have, and Mitch even found an insurance company that did mergers and acquisitions insurance, but it's being taken private. So I really want something to benefit off of this capital markets industry wave, if we have a mergers and acquisition wave and an IPO wave, and I don't have the right name to do that yet.
Yeah, it's hard to really get in there without touching the big boys, but when you're touching the big boys, you're already getting diversified amongst all the other stuff they do, so it's kind of hard to really, capitalize on those capital markets specifically.
Yeah.
B. Riley would have been the name, but I kind of agree with you. The reputation there's a little bit hard to come back from, but it seems like traders like it, investors not so much. That's where I'm worried.
Yeah, so I told my my subscribers, like, okay, I'm still watching and following B. Riley for my own education, but it's not something I'm recommending because it's, and I even still own a chunk of it, but it's just not, the risk level for my, that's not the sort of risk level that I would want to keep on my Substack. It's just too much. But this sector, the capital market sector within the finance, capital market subsector within finance, I think this is hot, and I think this is prime and ready to go. And I don't have the right name to invest there right now.
Open for suggestions.
So telecoms are following information technology. It's just, it's like a little brother. They're practically the same sector. I think the only reason that they split them up is because otherwise one sector would be 60% of the market. But they trade the same, they follow the same. They're like number one and number two together all the time. There's always, if you've talked about one, you've talked about the other. Financials, it has its ups and downs. It's very middle of the pack. Mitch wanted us to look at industrials. So industrials, and it's been strong this year. Let me go to, what is it? XLU. No, that's utilities. What's industrials? XLI? So industrials, wow, they didn't even really have the crash that all the other things did those last, that's 1 year. What was the 5 years? Yeah, industrials, if anything, they're staying strong. They're not suffering in the same trap that the tech companies are. They're breaking out. one of the things going on is that in 2025, you have the peak spending for the CHIPS Act, the Inflation Reduction Act, all the Biden spending bills that got passed early on in his term. They all have their largest spending years in 2025, and it's all very. And on top of that, you have reshoring. It's all very infrastructure, industrial related. And then I can go back to 1 year. So yeah, I mean, it looks good. It's going strong. I don't have anything else. It's just had this golden cross in October, where the oh no, wait, sorry, is that the death cross? The green is above the blue. Yeah, the 200 day is now over the 50. So that's, never mind. That is not a golden cross. I shouldn't try to do technicals without Mitch, but
He is our resident TA.
yeah, he's our go-to guy. If I go to industrials, the one area, so if I go that year to date, so you have a lot of the construction engineering just up 45% this year. The things that are struggling in industrials are all the logistics and transportation. And I had written about in my Substack a lot before that we've gone through the destocking cycle. A lot of companies have run down their inventory. And when that switches from destocking to restocking, then logistics and transportation, the trannies should be poised to break out. So industrials, it's only middle of the pack, but the hard industry, the construction, the building products, electrical equipment, this stuff is all of these subsectors beat information tech and telecom if it wasn't being dragged down by logistics. So I think logistics is poised to break out. I have Forward Air, but Forward Air, they just announced that they're shopping for a buyer. They'll probably get taken private. I mean, I wish Forward Air would give me those 2 years to pay down debt and to benefit from the restocking cycle. But no, private equity is going to come in and buy everything that I want to enjoy before it reaches its full trajectory.
So I can't blame them. It looks
Yeah.
too good. It's like taking candy from a baby.
Yeah, but the United States probably needs better, minority shareholder protections. In the World Bank's Doing Business report, United States ranks 40th in the world for protecting minority shareholders. We could do a better job. I mean, you just can't have so many wins ripped out of your mouth by private equity. It's getting really frustrating. But I'll look for another logistics transportation name to benefit from that bounce. There's Pitney Bowes, but they're more mail and post. It's not really true logistics. But anyway, so back to the map. Your thoughts, Colin?
Industrials, I see the presidential debates kind of being almost kind of like a catalyst for a lot of people loving that without getting into numbers or whatnot. It was basically a conversation of who can have, who can spend the most. Who's going to spend the most as the president? There was once a time where presidents were debating over who's going to spend the least, and it's pretty flipped on its head. At least in the presidential debate, that's what it seemed like.
Yeah.
I don't think I picked up too much of the VP one, but it was just, I'm going to spend more. No, I'm going to spend more. No, I'm going to spend more on this. No, I'm going to spend more on that. It was really, that was what the fight was about. So industrials, as long as the money's flowing, they're making money, sending stuff back and forth, shipping rocks across the country. They're happy. So I can, industrials are kind of like an easy, throw a dart at the sector and buy.
Yeah, maybe. I mean, it's done well. It's done solid, above average for the last, well, this is, 2022, it was negative, but still placed well. But it kind of always places middle of the pack, but, slightly above average. Same with consumer staples. It's never the last thing, but it's never the top thing. Industrial's never the top and never the last. I have a hard time finding the right individual names, although I did a 3-part write-up on tires with Goodyear Tire, because electric vehicles are twice as heavy and they accelerate twice as fast, so they burn a lot more rubber. So I had a 3-part series on the tire industry. And that also, in the consumer discretionary, the automobile parts part was really beaten down. So maybe when people have a little bit more money in their pocket, they'll buy premium tires instead of cheap tires. We talked about healthcare, consumer staples. It's always middle of the pack. I think I'm typically looking for more torque than consumer staples is going to provide. We can look at it if you want to just look at the subsectors, just out of morbid curiosity. But if I'm going to go fishing in a pond, I want to fish where the big fish are, and this just doesn't seem to me to be a a pond where there are really good fish. Although personal care products have been
Wow.
trashed, and some of the cosmetics companies have been getting a lot of traction for people talking about them. But I don't know anything about them, so this is a real confidence problem. To be able to want to buy some, Ulta Beauty or some what is it, Estee Lauder or any of those
Right.
symbols are so far outside of my competence. But yeah, the personal care products has been just beaten down. It's down 17% year to date. I don't know why that is. I mean, girls still like going on Instagram and making videos of themselves. So I am mad at myself for missing that rally over
I
time
mean,
because it
one
was.
idea could be. I mean, this seems a little late to be an explanation, but all those filters and stuff they use, all that AI technology that can change the way they look, maybe there's less a need to use makeup, especially if more life is happening online.
Yeah,
Weird theory, just so it popped into my head, but they always say makeup is kind of recession proof. People are always going to be buying, or girls are always going to be buying their lipstick, So this is kind of
yeah.
weird to see. It's almost saying, hey, we're not in a recession because why would makeup be down?
Well, I don't know if makeup is recession proof. It was more of the idea
Inelastic
was
demand.
if you're going to have one small guilty pleasure, one last luxury you hold on to, maybe that was makeup in the past, but I think it's Starbucks now. The Starbucks is the kind of luxury good that's the last thing people cut, maybe. I don't know. Another aspect of the personal care products industry. So, as far as 100 years ago, there was a well known pattern that women's skirt lengths changed with interest rates. That when interest rates were high, women wore long dresses, and when interest rates were low, they invented mini skirts. And that was something that had been talked about, but finally an economist went in and found it, and it does work, but it has about a 2 year lag. And we've seen that with interest rates being high for 2 years, suddenly the hot new trend on Instagram and these influencers, they're all talking about, how to stretch their budget, things like that. So maybe cosmetics, if people on their Instagram accounts, they're being less dolled up on like extreme layers of pancake makeup because interest rates are high. And that pattern that's been around for 100 years, that when interest rates are low, women wear mini skirts, and when they're high, they wear long dresses. Maybe it's bringing conservatism into that sort of culture. So I don't know for a fact that, and I just as a competence level, I don't know the brands that well. I don't know what brands I want to be in. So yeah, maybe I'll skip out on personal care products. What are your thoughts, Colin?
Personal products, I guess I would really want to see more of a breakdown of what those even break down into. Is makeup really leading the pack there, or is it something more like deodorant or shaving cream? I guess I'd be interested to see what's going on there.
The problems with a
What
lot of
kind of
those
breakdown?
products is you've got Johnson and
Big
Johnson, Procter and
companies making them
Gamble,
all.
Unilever, and they're such huge conglomerates. So if you can find something small, although and also with the food products. So two of my big winners I had written about, and one was before the Substack. So when there's a small company in a food, beverages, personal care, whatever it is, and you find a toehold. So I found Vita Coco had a toehold from Keurig Dr. Pepper. Lifeway had a toehold from Dannon. And these companies that have a toehold from a large super conglomerate, they get free advice and they kind of get, training wheels. They kind of tell the CEO, okay, you grow this thing as big as you want to grow it. And when you're ready to sell, we'll buy you out. And they kind of have this, it's the unofficial right of first refusal. Like they'll buy 5% of this company, and the understanding they're going to buy the whole thing someday as long as they don't screw up too badly. So all three of these categories that have underperformed consumer staples, beverages, food products, personal care, if I can find a small cap with a toehold from a large conglomerate, like I found with Vita Coco, like I found with Lifeway yogurt, those are all still viable. But toeholds are not easy to find because the information about 4% owner, 5% owner, it's just not. Sometimes you have to go back and look through press releases. It's not even written in the 10K or anything like that, unless they're a 10% owner. So it's not a dead industry, but it's kind of an if I find it. Sometimes you just have to get lucky and find it.
agree with that. Honestly, I think the best way to kind of get a grip on what's going to be happening moving forward with that industry of personal products, I'm just gonna have to wait for the 10Ks to come out, read through the big boys, scripts, see what kind of stuff they're citing for where these, stock prices are declining. What from?
Okay, well
I'm sure
now
they're gonna have to
into the
speak for themselves.
now into the underperformers, right? So we talked about consumer discretionary a little bit. I think consumer discretionary has a real strong chance to outperform next year. But we have real estate, materials, and energy. Dun dun dun. I'm so overweight energy, and it's been such an awful 2 years. Now, one of the real problems with energy is look at 2017 to 2020, where it spent 4 years, at the bottom of the stretch. Energy has the capacity to be the worst performing sector for 4 years in a row. So I don't have any strong conviction that 2025 is going to be the year for energy. It could be 2026 is the year for energy. I think it's due. I think we're still in the middle of a cycle where prices are high. What's amazing about it is even at $70 a barrel oil, so a lot of companies are buying back stock and just making tons of profits. The problem is if they increase production too much, they crash the price. But I still think we're probably years away from that. But anyway, I have no conviction that 2025 is going to be a good year for energy. But it could be. I'm already so overweight, I don't have to buy anymore. And I guess
Yeah, I'm
that's
not terribly worried. You see some demand forecasts being soft, claiming the economy slowing down, but then you see these sectors like AI and all that exploding, and all they're gonna need is more and more power.
yeah. I guess there's only two subsectors: equipment and services, and so it's either you're either making the energy or you're making the equipment for it. And I have both. So I have ACDC and I have Transocean in the equipment and services, and I have Vermilion in the Explorer and Producer. And I I am kind of hunting for a better Explorer and Producer. I'm not super happy with Vermilion, but there are things I really do like about it. I don't know if I told you this, Colin, but so I had kind of dismissed it at first, but Vermilion Energy had a lawsuit against the government of Ireland for their excess profits tax. I thought, oh well, that's
Oh, I
just
recall.
yeah, that's just them being angry about. And they should be angry about the money getting taken from them, but I just figured that
Yeah,
they
show the
were
shareholders they're trying.
yeah. So I didn't put much stock into the lawsuit, but I think they might actually have some merit there because the offshore rigs in Ireland that they're getting this gas from, that was built, at the request of the Irish government. They gave them a zero royalty contract for the explicit purpose of building that offshore extraction. And when you have a zero royalty contract, when they're going to come in after the fact and say, no, 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 we really do want to tax you after the fact, if I don't know how close Ireland's legal system is to British common law, but it seems like that lawsuit has merit. That you can't just say no take backsies and just take taxes from a zero royalty platform. So I think that the Vermilion Energy lawsuit does have merit, however many years that takes, and also their projects for making gas. I think it's in Slovakia and Germany. They're going to be making gas in Europe where gas prices are high, and Europe is not reintegrating with Russia anytime soon. So, and it's still years away for all the export terminals and all the LNG ships to get built. So, Vermilion's making money. They're doing share buybacks. Just management spends too much on growth, and I wish they'd spent more on returning capital to shareholders. But anyway, 2025 could be terrible for energy too. That's why I think it's definitely time to diversify. So that leaves real estate and materials. What do you want to tackle?
I mean, real estate, I'm kind of interested in. I think it's been kind of slagging behind the rest of the pack, mostly because, these companies have got a bunch of inventory on their books they want to offload, maybe, or prices have been kind of stagnant to declining. Not a lot of seller activity or buyer activity going on, but,
Yeah,
with these next few years coming in, interest rates hopefully coming down. I could see interest rate I could see real estate kind of seeing a big perk up from that, especially
yeah,
with the home builders.
yeah. It's interest rate sensitive. It's an inflation beneficiary. It hasn't been on top of the world in a few years, and it does spend. So in 2010, 2014, it was a top performing sector. So it has the ability to be on top of the world. Let me check the subsectors for real estate.
Always going to be that background factor of,
demographically speaking, we have a lot more people living at home, living with parents than ever before at older ages.
Yeah.
Eventually, hopefully, unless they just wait for their parents to go on and take over the house, we're gonna see people eventually, those millennials start moving out and start starting their own families, hopefully.
Yeah, and
You
well, I
know?
guess they're going to have to do it for the new home builders to get the low mortgage rates. But I did see an analysis that was kind of interesting the other day. Is that some of the historical time series, and you try and tell if there's too many houses or not enough houses. It's it's number of houses per person per capita and number of houses per household have kind of diverged because the divorce rates are so much higher now. So you might have two white collar professionals that are divorced, each having a primary residence, each having a single family home. So you've got, almost like one household per person for a big chunk of the country. And that's kind of new, and that's driving up the demand for single family homes. Is that there's so many more one adult households because you have women in the labor force making large salaries that can afford their own household after a divorce. So that's anyway. But as far as what's been lagging and what's primed to catch up, so office REITs were oversold and bounced back. Healthcare REITs surprisingly have performed well this year, although not Medical Properties Trust. They're still recovering from that bankruptcy of their tenant. Residential REITs, retail REITs, kind of middle of the pack. Then you have some real estate management companies. I think this is where, I don't know if the brokers are lumped into here, but this is where I have Douglas Elliman, specialized REITs, and then I'm surprised industrial REITs is negative. Industrial REITs, you typically have, it's kind of like the one of the most highly sought after kinds of real estate is industrial. They have some of the lowest rents, but some of the longest term tenants. I'm surprised that's negative this year. I mean, that could bounce back hard with this whole industrial push for next year. And then
Could have been
hotel and resorts.
some over-levered guys kind of going belly up on some projects. With rates being up for the past couple of years, there might have been a few people kind of conceding, shutting down shop. I don't know.
Yeah.
Like you said, that should be a pretty sought-after type of real estate.
I'm kind of reluctant to jump into hotels. I'm just kind of shocked at how well Carnival Cruise Lines and Royal Caribbean have performed. But this industrial REITs being down this year, that's something that I think really has a chance to bounce back. That might be an area to dig into. I'm really overweight on the land part of my oil, gold, land, inflation protection basket because I've got such an overweighting to Medical Properties Trust for when they finally, get out of their bankruptcy and restore their dividend to full capacity, which might still be a year and a half away. But I think I might be able to pare the position down on the next run up. But I don't know. I'm kind of interested in this industrial REIT category. And also, I haven't written about it yet, but I found a grocery store REIT that has a 9% dividend. It's on the small side, and grocery stores, when your anchor tenants go bankrupt and go out of business, it can be pretty rough. So it's really property to property. But anyway, let's see. And that leaves materials. What is going on in materials? And this is definitely an area where I'm overweight and I want to be here and I like it. There's not really any dispersion here between the different aspects as far as year to date goes. I mean, chemicals, mining, construction, packaging, it's all the same. It's all middle of the pack. But it's all underperformed this year. But at the same time, it never really has that many years where it's the top performing or even in the top, 3 or 4 performing sectors. It's got a lot of years where it's, bottom of the pack. I mean, you have the commodity supercycle thesis where low interest rates got everybody into tech, and so we've underinvested in building out new copper mines, building out new all kinds of other kinds of mines. But it's kind of not applying to energy because the shale revolution has, we did invest in energy. So I guess as far as materials go, I'd be more interested in the metals. Mitch wanted us to dig into this ETF. Was it not? What is it? SETM. Yeah. So this is the Sprott Critical Minerals ETF. He said that this one had record fund flows this last year. It's not that old to have that much history. Yeah, it bounced back hard. I guess a 1 year chart is good enough. So it's bouncing off really hard off of this September low, and it's really rallied up high. This is the Sprott Critical Minerals ETF, and I've got their components here. It's got a lot of stuff I like in the components. So by weight, their largest one is Linus Rare Earths, and it has Cameco for uranium, lithium, Freeport-McMoRan for copper, MP Materials, and it might be molybdenum. I can't remember. UEC, that's the we talked about that on the last call with Mitch. Albemarle is lithium. I'm really not a huge fan of lithium, but this is kind of an interesting ETF. There, what are they? 26% copper, 22% lithium, 22% uranium, 11% rare earths. Then it's some silver, nickel, manganese, other. And this is kind of an interesting ETF for because there's so much. So many problems with management in the mining sector. So if you just want to take a basket and let Sprott pick your miners for you, yeah, I'm not against it. This was Mitch's idea to look at, was the Sprott critical metals ETF. What do you think, Colin?
With minerals, it's a tough one. I kind of liked that one you were showing with, or this one you were showing with all their kind of holdings kind of spread out a bit. It really comes down to what kind of things we're going to be using for this new business cycle that we see coming in. And honestly, the way they're spread out, I see them being a winner just because whatever they got, it seems like they got something that'll be going up. They got something that's going to be in high demand.
Yeah, so
Not too
I'm not
concentrated in one spot or the other. They're not dependent on copper or something like that, for example.
well, I like copper and I like uranium because they both don't really seem to have any substitutes. I'm not really a big fan of lithium, and the Chinese are already switching over to these sodium ion batteries and getting some pretty good traction out of it. So I don't know. I don't know how many years lithium has left, or people are going to put up with their cars catching on fire.
Yeah, that's been a real big thing. That's one of the big things that's keeping me from getting into that EV space. Just the problems they have with those
Yeah,
fires. They're so catastrophic, and there's like no way to put them out. It's really kind of like a scarecrow keeping me out of EVs in particular, but
yeah.
lithium batteries as well.
Yeah, and then with the flooding in Florida after the hurricanes, you have, okay, you get the storm surge comes in and you got salt water. Okay, now you've submerged a lithium battery in salt water and it's going to catch on fire now. Like the car is totaled and trashed. Yeah, I mean, electric vehicles, probably we're all going to be driving them like 30 years from now, maybe 40, 50 years from now, who knows. But I feel like that battery technology has room to change, and I don't feel like lithium has the same legs to it that copper and uranium do. But I do think for people that just want to punt and don't want to dig into the individual miners, this is not a terrible ETF. So that's the sector map. So where do we want to be for the last part of this year, for the last part of this rally? Probably what's been working is going to keep on working because you've got people chasing performance and you've got people tax loss harvesting. So I expect all of my energy names to fall into the end of the year, and I expect all of the tech names to rally into the end of the year. But then going into 2025, that consumer discretionary, materials, real estate, health, industrials, financials, but capital markets. I don't know. What are you thinking, Colin? What's the best sector pick to look at for 2025?
I'm loving financials personally, just because they're so isolated from so much of the inflation costs, kind of killing some other industries, like healthcare, namely. I
So,
don't know. I just love the way financials are positioned to take advantage of, the supply of money just being increased with this increase in activity.
so from the last trough, so for this whole bull market, you have financials have had quite a rally in the last few months, but they're still pretty far behind a lot of other sectors. They could keep going strong. What is this? Is this
That's the SPY.
yeah, so the black is the SPY. This color is that so? I'm half colorblind. Some of these colors are
Might
too
be
close for me to pick out.
industrials.
Yeah, there's a lot of sort of teal cyan kind of colors in here that I can't really separate. But I can
I believe
definitely
that's
tell that this
industrials.
is information technology and communications that have just been just ripping away with this artificial intelligence boom. They could take a breather in 2025. The prices on them are so high, and also the cash flows from AI might be so far away. They could take a breather. I think healthcare is down here, and energy is far and away the worst performing. Utilities have had this aggressive rally. I mean, utilities were the worst performing, and then this year they're up 30%. They're still only middle of the pack, but the utilities are always only middle of the pack. I mean, utilities they're known for their dividends, not for their returns. They're kind of supposed to be middle of the pack. And then what else do you have? It's going to be consumer discretionary is in here in the middle of the pack.
I mean, healthcare's
Industrials,
where I would go dumpster diving. If you're looking for 2025, where to start hunting, I mean, healthcare could be bombed out. I think healthcare might bottom out, might be somewhere to start dumpster diving in the next few quarters.
yeah, yeah. I like healthcare, and I also like consumer discretionary. You don't see a lot of years where consumer discretionary is consumer cyclical. It's not usually down that 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 many years in a row. So I definitely look at consumer discretionary. I'm going to look back into that Malibu boats, healthcare, industrial real estate, some of the metals. Yeah, I don't think this metals rally is all worn out. So I definitely like the metals, and I'm don't have as much exposure to the metals as I want because I was too overweight energy, which has been the wrong place to be for 2 years. But when it bounces again, I mean, some of these names have bought back float. They're increasing production. There's when I don't know if energy is going to be a 2025 story or a 2026 story, but it's going to have another year where it's the best performing sector. And with this inflationary environment, having a 50 or 60% return for a year it's kind of overdue for one of those. We'll see. We'll see if it's 2025 or later. But marginal dollar. What were the names in consumer discretionary? Oh yeah, it was automobiles, auto parts. Maybe it is time to look into those. Maybe it's time to look into Goodyear Tire, Advanced Auto Parts a little harder, Orion Engineered Chemicals, and then the luxury goods. So I'm slowly building my position in the Container Store.
Take another look at auto parts, honestly. I'd start looking into those again. Parts
Yeah,
breakdown, you gonna need new stuff.
yeah, and it's just been underperforming so hard. It's been underperforming hard for a long time. So yeah, and then what else was it? Communications, financials. So it's capital markets and financials. So summarize. The thing I like about financials the best is capital markets. Now that B. Riley is kind of out of commission, I need to find a new small cap name that's going to benefit from capital markets. Industrials. So I have Alta Equipment Group. That's this debt fueled roll up where they have the it's a forklift dealership business and also other kinds of truck dealerships as well. But they have these same way as a car dealership. You have the two-way monopoly where they have to buy their Hyster-Yale forklifts from your dealership and they have to get the servicing and parts through your dealership. And it's really a parts and service business. And they've been doing this debt-fueled roll-up. And also, it can't be bought out by private equity because Hyster-Yale has a requirement that their dealerships are not allowed to be owned by private equity. So I really like Alta Equipment Group. And this huge industrial build out for all these warehouses and whatnot, and the industrial construction, as those come online, they need to fill them up with forklifts. So we'll see what happens. I like that Alta Equipment Group and industrials, and then on real estate, the real estate services, Douglas Elliman. I can look for an industrial REIT that I like. So what I have, energy. I'm already overfull. I can't really add any more. Consumer discretionary, I'm going to look harder at automobiles, luxury brands, the Container Store, Advanced Auto Parts. maybe Goodyear Tire. Materials, more to the metals, energy transition metals. Also, the gold rally has been pretty aggressive, but it also might not be over because you got both presidential candidates highly inflationary. Real estate, Douglas Elliman, healthcare, health services. I want to look back into that. I forgot the name that Mitch had, but it was a healthcare company that was focusing on nurse job placement. It's kind of a health services company. Consumer staples, if the name pops up, I'm always happy to find one with a toehold, but I'm not going to, this is not a pond I go fishing in deliberately because it's such a mediocre pond. It's just better fish usually elsewhere. Industrials, I've got Alta Equipment Group, and financials, capital markets. Anything you think we should add to that, Colin? Any strategies we're missing?
I mean, you're hitting it hard as far as the sectors go. I think maybe next week we could try to get a little bit more into that emerging market kind of thesis, kind of look at the different sectors from like a global perspective, kind of chop them up differently, see what different areas geographically are going to be doing in the next few years.
Yeah, there have been so many talking heads on television talking about having a weak dollar for several years. But at the same time, if the United States has the cheapest energy, it might be hard to have a weak dollar while we have cheap energy. Because everybody
To be
we're
honest,
going to be,
the
yeah,
activity I'm seeing in the international markets lately on the equity side of things, energy was something we were doing earlier in the year, really the beginning of the year. These days, gold went through the summer, but these days it's much more your consumer type stuff. You're seeing the chip makers, you're seeing the luxury goods, drug makers, infotech. That's really the kind of stocks I'm
yeah.
seeing a lot of volume on from an international equity perspective.
I'm not talking about investing in energy. What I'm talking about is for industrials, for having a
Mm.
weak dollar to promote exports. Well, how weak can the dollar get if our electricity is cheaper in the United States? And so, we don't need the weak dollar to stimulate exports because we have the cheap electricity to stimulate exports. So when companies are looking at where do they open their factory, where do they want their import-export relationships, how weak can the dollar really get if we have the cheapest electricity? Now, not everywhere does have the cheapest electricity because they've, burdened the grid with some solar and some wind and all some crazy stuff that drives up the prices. But if you're looking at, especially in the Sun Belt, if you've got some of the cheapest electricity in the world, how weak can the dollar get? Even though I know there's some very, very smart people projecting, time to internationally diversify, time to, time for the weak dollar for several years. And if Trump is really pushing low interest rates and he gets it and he's successful at that, maybe that is the pattern. But I'm not 100% sold on emerging markets. But yeah, we can do a whole different strategy section on emerging markets, which countries to look at. I've kind of nailed down Argentina, Brazil, Poland, South Korea, and Japan. But we can definitely we can test that. We can talk about it. Anyway, anything else to add, Colin?
Keep an eye on China and don't forget to watch that 10-year.
Yeah, no joke. If this climbs back, to, it was really putting some pressure on the market when it was getting close to 5. Anything over 4.5, the stock market really starts to feel it. So we'll see. I don't have Mitch here for the technicals, but if you can try and tell from this where the 10-year is going, I have no idea. But yeah, it did surprise a lot of people when Jerome Powell cut 50 basis points and the 10-year started rising and not falling. So we'll see if Jerome Powell keeps up his cutting trajectory to do, 25 basis points in November after the election, and then 25 basis points every meeting or every other meeting if he's on that path of what the 10-year does. I think that is going to be like gravity for the marketplace. But all right, Colin, thank you very much for coming. I really appreciate your take on things, and I look forward to seeing you and Mitch again, probably in a couple weeks.
Yes, my pleasure, Coach, as always.
All right, have a good one.